Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and John Briggs. Now, this is the last Bondcast of the year, so we're going out with a bang with a real central bank bonanza this week. Let's start with the ECB. We're recording this on Thursday, just after the ECB, and I think it's very fair to say that the ECB was probably the most market moving. So let's begin there. And I suppose one of the most market moving elements was the QT announcement that we had today. So Giles, what did we learn about QT today?
Well, I mean, that side was a little bit different to our expectations, not in terms of what we eventually expected to happen, but just in terms of what was actually announced. We thought it would be much more focused on, principles, rules, and so on, and then an actual announcement would be for the February meeting. And what we actually got was the other way around. We were told that in February we'll get the details, and it will actually start in March. So at the beginning of March, we're going to get a quantitative tightening of 15 billion per month. So 15 billion was pretty much our expectation. An easy number to pick because that is, roughly speaking, half of the monthly reinvestment that they will be making. So nice and simple. That's what they went for. So, compared to expectations, I would say that was a little bit on the hawkish side.
What about the rest of the meeting then? I suppose a 50 basis point hike was pretty much nailed on, which was what was delivered. But how about the kind of tone of the press conference itself? And then also, of course, this was the meeting where we got the updated macroeconomic projections and for the first time saw how they saw growth and inflation developing in 2025.
Yeah, so I don't think we can accuse Madame Lagarde of not having been clear in her messaging this time around. She started off hawkish, and she continued hawkish, and she ended up very hawkish. It was the most hawkish thing I've seen in, I think, forever from the ECB. It was really quite extraordinary. So, I'll just go through a few things. I mean, first of all, just starting with a couple of points that, I will read because she read, but no, I won't. I won't labour the point. They talk about still having to raise rates significantly until they reach levels that are sufficiently restrictive. Okay, so when she was obviously asked exactly what they have in mind by that, she was pretty clear that we should have in mind that means 50 basis points at the next meeting, and quite possibly the next one and the next one far into the future. So I think we're definitely pricing in, penciling in, let's say, a 50 basis point rise in February. So, what other things, would you highlight? I mean, I've already mentioned quantitative tightening. The forecasts, they were hawkish as well. Pretty mild recession is the base case, and a pretty prompt return to trend-like, maybe above trend growth in 2024, 2025. A profile for inflation which doesn't get back to where they want it to get to, pretty clearly. She actually went as far as to say that, or to wish that in the next round, the market rates that they condition their forecast round on will have moved sufficiently to allow them to project inflation getting back to target in a timely manner. So a very, very clear message from her that the market is not at the right place right now. So as I say, taken as a whole, it was a pretty hawkish delivery.
So used to saying dovish. Yeah, super hawkish.
I know.
I don't think Lagarde has ever been as clear as she was today.
No, it was a very strong performance, I thought, actually, today.
Nice. Finishing the year with a bang. I like it. Let's away from the ECB then, the other kind of main news this week and something that the other driver of underperformance of EGB, European government bonds, was the issuance outlook from Germany that we received yesterday. You and Joanne were both very excited about this. So perhaps you can talk us through those numbers and what that means for your Bund forecast for next year.
You're quite right. It was a very, very exciting week for bond geeks like me. But anyway, listen. So, what did Germany say? They basically have planned for next year close to 300 billion in bond sales, which once you add in syndications and sales from their withheld portfolio, now I think you're probably talking about something in the region of 340 to 350 billion. On a net basis, that means 160 billion. Now, after years and years and years of essentially negative net supply, this is a really, really big change. Compared to our projections, we go through the forecast around across countries fairly carefully after the draft budgets in October. And we come up with broadly reasonable, but Germany's always the biggest sort of wild card, to be honest with you. It's quite difficult to forecast then. But we're talking about 100 billion more bonds from them than we had penciled in. So this is a really, really big change. It pushes our total gross supply forecast for next year up to about just over 1.3 trillion for all EGBs. This is, as I said, it's a really big change for European fixed income, but especially for Germany after so many years of negative net supply. And in addition to that, we're going to get a lot more bills. So the bill stock is going to increase by about 40 billion, and they're probably also going to be using their repo lines. So I think that the questions around the collateral shortage that we have developed over all these years in German collateral specifically is something which is very likely to be fixed next year. I mean, this is something we've been talking about for quite a while, of course, but I think after yesterday's announcement, that looks much, much more likely. So obvious consequences. This is very much supportive for asset swap tightening, so bond underperformance of swaps. And just taken together with the more aggressive QT announcement today, I really think that this sets us on the road towards high rates next year. Today, I think we had about a 14 basis point, before I left the desk to come and do this, 14 basis point sell-off on the day in 10-year bonds. That, I think, is really only the start.
Yeah. Okay. Regular listeners will know that those are themes that we've been talking about for a long time, but nice to see that the two kind of main events this week have just added that conviction on those as we head into the new year. All right, then. It wasn't just the ECB. We also had the Fed. So let's talk about that for a second. And this week we've got John to join us. What are your key takeaways then, John, from yesterday's meeting?
Yeah, so our views on the meeting results are a little bit different than the market interpretation, to be fair. The dot plot, we'll start with the dot plot and the SEP and the summary of economic projections. And I think there's 3 points here that we took away as hawkish. The first one was that the median dot for next year went all the way up 50 basis points to 5.8. And we had that going up to 4 7/8. And the reason why we didn't have it going above 5, despite our own view that the Fed funds rate ends in a 5 to 5.25 band, is just the number of participants you would have to need to get up above 5% seemed like a lot for one change in the SEP at a time that the Fed is kind of acknowledging that rates are slowing, the pace of rates are slowing, and we thought there was ample time for them to kind of do that or even get there versus the dot forecast over the next several months. But this leads to my second point, all but 2 members were above 5%. So you had 2 members at 4 7/8, the bulk at 5 1/8, and then you had 5 at 5 3/8, and then 2 more at 5 and 5/8. So not only did the median go over 5%, but the dispersion was solidly above 5%. So that's the second thing that we thought was pretty hawkish within that. And then the third thing in the SEP was the raising of their inflation forecast for the end of 23 from 3.1 to 3.5. So taking all that together, they now see tighter policy, plateauing policy that is at tighter levels, but inflation still going up. So that is so that means like your band of error or your risks, if it's a risk management approach, is actually towards higher than what they're expecting on the Fed funds rate rather than lower. So we took that as hawkish, and the market did initially start to see a bear flattening move, but then during the presser, we saw that reverse. Now, as investors know, markets have been in this optimistic mode that the peaks are in and central banks will be pivoting. I think that in Europe that got smacked back pretty good today, but it certainly is embracing this optimistic move of lower yields, which has caused a weaker dollar and better risk assets. And as we know, that all combines into looser financial conditions. And if you look at financial conditions, they're almost as easy as they were in August when there was a strong concerted effort by the Fed to push back against that. Now, to be fair, policy rates are much tighter. But if you look at, we have our own financial conditions index, but even if you look at anybody else's or Bloomberg's, it's getting to the point where you're almost at zero, right? In other words, like a positive number is easy, a negative number is tight. For our own index, you got to, 2 standard deviations tight. We're now at 0.25. So you really have the markets are starting to unwind a lot of the work that's being done. And I will fully concede that we had a good inflation number, and it was the second good one in a row. However, there's still a lot of work to do, and I think the Fed will push back against this easing of financial conditions. And this is where we come to the press conference, which the markets seem to take comfort in, or it could be a mid-December risk averse. Okay, I think it's hawkish, but my risk manager is looking over my shoulder, and we've closed up the books, so I'll put this into next year. Fully possible, but still, we did see some of that bear flattening unwind. And the market seemed to take comfort in the idea that he flagged core services ex housing. That was only up 1/10 this past month, which was good. But we see that still being kind of sticky. And Powell talked about wages working into that, and solidifying the idea that they could step down to 25 basis points next year. That was already priced in the market, but the market does have this kind of rosy lens. And just circling back on the financial conditions point, we've been feeling like the Fed should be pushing back against that a little bit more. Now, that hasn't been the correct view. He was pretty zen 2 weeks ago. But in this speech, in this press conference, he said that it's important over time that financial conditions reflect the policy restraint we're putting in place to return inflation to 2%. So I expect kind of as we go into the new year, the Fed's going to continue to be hawkish, and with what the markets got priced in now, which is about 4 7/8 policy peak in May, and then cuts coming after that, I think that's really at risk. Might just take till next year to get there.
Okay. I think it's interesting as well, obviously I'm not at the desk now, but when we left, EGBs were selling off significantly after the ECB. Gilts, although they were still lower on the day, they were selling off as we left, but treasuries were still rallying through that meeting. So there's been some kind of follow through on this dovish interpretation of the meeting, which, as you say, it seems a little bit misplaced at this point.
Yeah, and to be fair, it seems like there's been an underinvestment or underdeployment of cash in the last several weeks that's been fueling some of this. It hasn't come, the data at least shows that it hasn't come from foreign investors, and we know the cross-currency hedges don't make treasuries very attractive. So it appears to be from, domestic sources. As I am in front of my screens, luckily, so we are seeing, that further sell-off. And Giles, well done. Bunds are now off 15 basis points. Your call's getting closer by the minute. But we're starting to see a little bit of a follow through. But for us, we liked 10-year yields at 4.25, 3.50. We just think it's premature here. So we are more bearish on that. That's a tactical trade versus some of the forward steepeners we have for a year ahead trade.
Yeah, I would say we have been doing a lot of kind of marketing in the last couple of weeks with our year ahead document. And it seems a common theme amongst clients that, they're kind of taking chips off the table and winding down for year end earlier than you might otherwise have expected, which I guess is driving some of these kind of outsized moves versus the kind of underlying fundamentals in the data or central bank rhetoric that you might have otherwise expected.
Yeah,
But
I never love relying on that, right, as a strategist. So if, and you never know the beginning of January. You mentioned client meetings, and I think a lot of the feedback that I've been getting in these conversations, even after the good CPI report, is an underlying concern out there that, yes, you're going to get inflation coming down, but the market's assuming this, just like everybody thought inflation's going to 8, 12, 20% when it was soaring and Fed's behind the curve. Now everybody, seems to be a market assumption that it's going to go right back to 2%, no problem. But I would say the most common concern about the long term is that inflation gets down to 3.5 and then stops going down. So not reflected in market prices, but that's the biggest concern that I'm finding amongst people of late.
I guess just touching on inflation then, because although it feels like a long time ago now and a lot has happened since then, it was also, of course, not just a major central bank week, but also a major data week this week. And we had the US inflation print, which came out a little bit softer than expected. What's your take on that? Is the peak now in? Is it too early? How do you read it?
Yeah, the peak's in, but importantly, and the number is good. I'm not going to push back against that. Like I said, that core services ex housing, Powell divided inflation into three things: goods prices coming down. We knew it was going to come down. We expected it to come down. That's happening. Housing inflation, which will be sticky until the middle of next year. We have the same lags, which is why in a lot of ways, which is why we think a Fed pivot's going to be delayed and that steepening is going to be delayed, that bull steepening, because that's going to prevent inflation from falling below 5% for the first half of the year. I mean, are you going to pivot with inflation at 5%, given your forecasting track record on inflation? Feels a little high. So, and the third thing was core services ex housing, and that's what the market's focusing on, rightly so. Powell's just flagged it, and that was only up a tenth. So that is good. There are some things within that'll persist, but there's a lot of components that we think won't persist. A lot of the transportation stuff that was lower. I mean, I don't know if you've taken a flight lately. Airfares certainly don't seem down several percentage points to me, but we know that's not how it's calculated. But we do think that there will be ongoing stickiness, and even after the report, like I said, we still have core CPI with a 5 handle on year over years. To be fair, 3-month annualized, 6-month annualized, those things are going to take on more importance. But it's a long road to go. So, and just lastly, when you look at, for example, inflation swaps or break evens, they've fallen a lot, and we think that there's might be an opportunity there as well.
All in then, I guess, with given everything that we've learned this week on the inflation front from the Fed, how does this leave your sort of longer term views heading into 2023 as we sort of round up the year before the holiday period?
Yeah, I mean, it's been pretty similar to our year ahead outlook. I mean, as I said, we're short 10 years on a tactical basis. A lesson of good entry level helps you, because that was from 350, and we've been, even with all of this news, it's been mostly a front end move, which we felt was the risk. We went out further out the curve. So, but that's a tactical trade. If we get back to 410, it's enough. The longer term view, the main view was 530 steepeners as we do see the cycle turning. The difference for us versus others, because that is a fairly common view going into next year, was the timing, though. Thinking that the Fed, the market pricing of what's priced in now for both the level of rates and the timing of the cuts is incorrect. So it's going to be pretty choppy, and we could see the market easily selling off even in the front end here if Fed pushes back into the beginning of the year, or the next inflation print shows that it's going to be a bumpy road, which is what we think. So we still have that view, and this curve has steepened in our favor. Last I checked, it was about 12 basis points the same date in our favor. However, we're not spiking the football, the American term I'll use, American football, right in the middle of the World Cup, right? But we think that over the medium term we will be steeper curves. We just are kind of curbing our enthusiasm a little bit ahead of as we go through the year. And like I said, I think some inflation hedges here might be appropriate.
Okay, that makes sense. And I'll forgive you for the World Cup reference. I think this will help me a little bit here.
All right. Well, thanks for forgiving an American on a British podcast. So let's turn to actually back to you, Imogen, on the Bank of England. Let's just key takeaways. What's your feeling here? Market's taking a little bit differently than the ECB, I would say.
Yeah, well, I think this week's Bank of England was always set up to be probably a little bit less exciting than the Fed and the ECB. It wasn't one of their kind of quarterly meetings, so we didn't have a press conference or any updated forecast. So it really was just about the size of the hike, and probably actually more importantly than the size of the hike, the vote and any kind of indication that they gave around the direction of travel of, well, not the direction of travel, but the trajectory of rates in the future, because I think that market consensus was very strong for a 50 basis point hike, although regular listeners will know that we had kind of been peddling increased chances of a 75 bip hike. Although, in a similar kind of way to the US this week, we had inflation that came out softer than expected. And I think to the extent that there was a chance of 75 basis points, that probably poured a little bit of cold water on that. So a 50 basis point hike, very much in line with market consensus and what the kind of analyst consensus and what the market was pricing. The vote was probably what drove the more dovish market reaction. It was a 6-3 vote, 6 in favor of 50 basis points, but there were 2 dovish dissenters, so 2 voting for no change and only 1 for 75. And I think that was a little bit more of a dovish skew than markets were really expecting, and that's what's kind of drove a little bit of repricing today in gilts, although actually, as you say, they've kind of been led by EGBs now and the big move that's followed the ECB. So that move has been a little bit diluted. I would say our take is that it's probably a bit less dovish than the market has interpreted it. I think similar to what you were saying, John, yes, on the headline seems relatively dovish, and Bloomberg was picking up all the headlines around Bailey saying that they felt like inflation had peaked and labor market tightness had perhaps peaked. But once you read into the detail of that, actually they talked about upside risks on all of those things and a huge amount of uncertainty. So just to, again, like Giles, just to read out a couple of comments that they made, because I think that really reiterates the point. They said that the labour market remained tight, that domestic wage and price pressures could indicate greater persistence. Private sector wage growth had increased significantly while continuing to surprise to the upside, and inflation expectations could be slow to adjust downwards. So although a headline dovish read, I think actually in the nitty gritty, it wasn't that dovish. And perhaps the key takeaway here is that the BOE has just adjusted its reaction function. So it now considers 50 basis points to be a forceful hike, whereas, 6 weeks ago, 75 basis points was forceful.
So 2 questions. In those those voting for 0, I mean, are they just looking for, they think the pass-through is going to come more quickly of past hikes, or was there any indication, or what do you think that was behind that? And then was there anything on QT on today?
So in answer to the first question, I think it is about this lagged pass-through of monetary policy. And we've been talking about that a lot, both on this podcast and in our written notes, but it's really only the doves, so Tenrero and Dingra, who have noted that in their recent speeches. We don't get a huge amount of detail of their kind of personal views in the minutes, and maybe those will be developed over the coming days by individual MPC members. But in the speeches that we had running up to the meeting, it was really only those doves, Tenrero and Dingra, that had kind of picked up on or talked in depth about this lagged pass-through of monetary policy, and the fact that, we estimate only about 15% of the tightening that has so far been delivered to date. So that kind of, now more than 300 basis points in the last 12 months, only 15% of that has passed through to the real economy, which is largely a kind of function of the structure of the mortgage market in the UK, that 80% of it is fixed and on average fixed for about 3 years. So, that's why we've long had this view that bank rate doesn't need to peak as high or as late as the market is expecting. We still think that bank rate peaks at 4.25%, but now in March, so still in Q1. And even after that peak, tightening is still going to be delivered because of this lagged monetary policy pass-through effect. And on the second question, Nothing really new on QT. I don't think we should have been expecting much. The bank has been quite clear that they're going to kind of decouple announcements and decisions on QT from this, meeting by meeting approach at the MPC. Well, the only thing we did learn, which anyway will be mostly redundant by the time most listeners listen to this, is that we will get the auction calendar on Friday. So tomorrow, for QT auctions in Q1, quantitative tightening, active sales in Q1 at 6 p.m. tomorrow. We knew it was going to be tomorrow, we just didn't know the timing. But like I say, semi-irrelevant. I guess that the major news this week on QT has just been, how strong the demand has continued to be for those financial stability sales of long-end gilts and linkers. The BOE is making really significant progress on selling down that stock of its bonds, and that adds to my conviction that they add the long bucket into regular QT sales next quarter, which we will know about tomorrow.
All right, and lastly, before I turn back to you as host, same question to you: has any of this altered your market views going into 2023?
Honestly, not really, to be honest. I think today's meeting was pretty uneventful from that perspective. It has slightly altered our bank rate call. Probably should have mentioned that before now, but we still see peak rates at 4.25. But we've just pushed that back slightly. So we did have 75 bips in today and then 50 in February. And we now know 50 bips has been delivered today to take bank rate up to 3.5. We think another 50 in February and then 25 basis points in March. So still the same peak, but just slightly later than we previously expected. That continues to be slightly lower. I mean, the gap between market pricing and our peak rates has narrowed significantly off late. But probably the major difference between us and the market is just the timing still. We have that peak earlier than the market is expecting. And the only other, I guess, market point I would make when it comes to bank rate is just the initial reaction, given that the market interpreted this quite dovishly, was to price in some very small amount of cuts at the back end of 2023. Now we're really only talking 1 or 2 basis points here, so kind of nothing. But if that pricing persists and we start to see bigger chances of cuts being priced in 2023, I would just push back against that a little bit. We don't expect any cuts in 2023 and expect them only to come early 2024. So just something to watch out for, I think, as we head into next year, about how the market thinks the BOE really pivot or otherwise next year. And for longer dated rates, I still think that next year is going to be much more about funding the fiscal deficit and the associated issuance that comes with that at the same time as all of this quantitative tightening from the Bank of England. So much less about bank rate expectations or even global central bank expectations, but much more about the supply outlook. And yeah, as I say, nothing really there on that has changed this week. And how the market was reacting at the beginning of this week to that heavy supply schedule that we had last week, with the Bank of England coming every day and the DMO with the curve steepening, gilts underperforming swaps and gilts underperforming on a cross market basis. I think that's really your playbook for how to think about longer dated rates next year as well.
Yeah, and that leaves us with steepeners all around. Some similar reasons, some US more timing, but Europe and UK on supply, and a general pushback on any central banks looking to ease rates in 23. And I think that kind of goes back to at least something that I've been thinking about, which is that peak and hawkishness, which is what we're going through now, is very different from a pivot dovishly, and as the Fed likes to say, thinking about cutting rates. That's still far down the road, I think, in a lot of markets. So
I completely agree. I think I wrote in the year ahead that 2023 is much more about a plateau than a pivot, and we still hold on to that view for now. All right, then, that rounds up the last Bondcast of the year. Just a reminder to our listeners, if you like today's episode, please don't forget to hit the like button and click subscribe. And I hope you will have a restful holiday period after what has been a particularly eventful year. And we will return in January with our weekly episodes. Thanks very much. See you soon.